They told you the world is stable. They told you the financial markets are under control and the institutions protecting your wealth are indestructible. But the charts are starting to whisper a different story, and the ancient metals of kings are beginning to shout. When you hear the projection of $8,500 gold and $500 silver, it is easy to dismiss it as noise or hyperbole. However, history suggests that these numbers are not just targets. They are symptoms of a systemic fracture that is already occurring beneath your feet. We are currently living through a period where the global debt has surpassed $315 trillion, and the United States national debt has climbed past $35 trillion. These are not just statistics. They are the cracks in the foundation of the modern world. I remember speaking with a veteran floor trader who had survived the stagflation of the late 1970s and the tech bubble of the year 2000. He told me that the most dangerous period is never the crash itself, but the silence that precedes it. It is the moment when the majority of the population believes that tomorrow will look exactly like yesterday. While the general public is distracted by the daily cycles of political theater and social media trends, the smart money is quietly moving toward the exits of the paper currency system. They are shifting from promises to assets. They are moving from liabilities to certainty. If you are watching this right now, you are beginning to notice the signals that others are conditioned to ignore. You are standing at the threshold of a massive wealth transfer that happens only once in a lifetime. Gold has been the ultimate arbiter of value for over 5,000 years. It does not require a central bank to validate its worth, and it cannot be printed into existence by a committee of bureaucrats. When gold reaches toward $8,500, it is not necessarily the metal becoming more expensive. It is the purchasing power of the dollar and the euro and the yen evaporating in real time. We are witnessing the slow-motion collapse of the fiat experiment that began in 1971 when the link between the dollar and gold was severed. Since that moment, the dollar has lost over 98% of its value relative to gold. The signal is clear. The global financial system is being rearranged, and the furniture is being moved while the lights are still on. Silver is the sleeping giant in this equation. Often called the poor man gold, silver is actually one of the most essential industrial commodities on the planet. From solar panels to electric vehicle components and high-end electronics, silver is the conductor of the modern age. Yet it remains one of the most undervalued assets in history compared to the amount of currency currently in circulation. When silver begins its move toward $500, it will not be a gradual climb. It will be a violent correction of decades of price suppression and artificial supply. The world is waking up to the fact that you cannot run a digital economy on paper promises alone. You need the physical steel and stone of the financial world. Your financial life is defined by the actions you take before the headlines make sense. Most people wait for the validation of the evening news or the approval of the crowd before they protect themselves. By then, the door is already closed and the price of entry has skyrocketed. The winners of the next decade will be those who chose to become silent builders. They are the ones who converted short-term paper income into long-term physical security. They recognized that the world was whispering a warning, and they had the courage to listen. This is not about fear. It is about positioning. It is about understanding that when the storm arrives, the only thing that matters is the strength of your fortress. To understand why gold is moving toward $8,500, we must first examine the structural integrity of the house we are living in. The global financial system is built on a foundation of debt and trust. However, in the year 2026, that trust is being tested by the sheer weight of mathematics. For decades, the world operated on the assumption that governments could borrow infinitely as long as they could service the interest. But the physics of finance have changed. With the United States national debt expanding by $1 trillion every 100 days, the interest payments alone have now surpassed the entire defense budget of the nation. We have reached a point where the system is no longer growing because of productivity, but is merely surviving through the issuance of more debt to pay off old debt. This is what economists call a debt trap. When a central bank or a government finds itself in this position, they have only two choices. They can default on their promises, which would lead to an immediate global collapse, or they can inflate the currency to pay back the debt with cheaper money. History shows us that every empire eventually chooses the path of inflation. By printing more units of currency, they quietly tax the savings of every citizen without ever passing a bill in Congress. This is why your groceries cost 40% more than they did 4 years ago, even though the official data claims inflation is low. The architecture of the system is designed to favor the debtor and punish the saver. This fragility is the primary driver of the massive shift into gold and silver. The banking sector represents another layer of this fragile architecture. We are currently operating under a fractional reserve system where banks hold only a tiny fraction of the actual cash that people believe is in their accounts. In an era of digital banking and instant transfers, a loss of confidence can trigger a bank run at the speed of light. We saw the beginning of this in early 2023 with the collapse of several major regional banks. Since then, the cracks have only widened. The commercial real estate market is sitting on nearly $2 trillion of debt that must be refinanced at much higher interest rates. This is a ticking time bomb inside the balance sheets of many financial institutions. When the public realizes that the safety of their deposits is an illusion, they will rush toward the exit of physical assets. Central banks around the world understand this fragility better than anyone else. This is why they have been purchasing gold at the fastest pace since the late 1960s. While they tell the public that the dollar is stable, they are quietly filling their vaults with the only asset that carries no counterparty risk. In 2024 and 2025, we saw record-breaking purchases from nations like China, India, and Russia. They are not buying gold for jewelry. They are buying it as an insurance policy against the collapse of the dollar-centric financial order. They are building a new architecture that is backed by something tangible because they know that the era of unbacked paper currency is reaching its inevitable conclusion. This fragility is not an accident. It is the natural end stage of a credit expansion cycle that has lasted over 50 years. When the system becomes too heavy, it becomes brittle. It loses the ability to absorb shocks. A geopolitical conflict or a sudden spike in energy prices can now trigger a chain reaction that the authorities can no longer contain with simple interest rate adjustments. Gold at $8,500 and silver at $500 are the market prices for a world that has lost faith in the paper architecture. You must ask yourself if you want to keep your wealth inside a glass house during a hailstorm or if you want to move it into the fortress of physical certainty. To predict where we are going, we must understand where we have been. History is not a straight line, but a series of repeating cycles, and the financial cycle we are currently exiting is one that the world has seen many times before. From the Roman Empire to the Weimar Republic, the pattern of currency debasement follows a predictable script. It begins with prosperity and expansion, then moves into overextension and debt, and finally ends with the desperate printing of money to maintain the illusion of wealth. We are currently in the final chapters of that script. By looking back at the major monetary resets of the 20th century, we can see the roadmap for the $8,500 gold price. The most significant turning point in modern history occurred in 1971. Before this, the world operated under the Bretton Woods system, where the dollar was pegged to gold at $35 per ounce. When the United States began printing more dollars than it had gold to back them up, foreign nations started demanding their physical metal back. President Richard Nixon was forced to close the gold window, effectively ending the last link between money and reality. In the decade that followed, gold skyrocketed from $35 to over $800 per ounce. That was a 20-fold increase in less than 10 years. If we apply that same historical math to our current baseline, we can see that $8,500 is not an exaggeration. It is a historical rhyme. Another vital lesson comes from the Great Depression of the 1930s. During periods of extreme economic stress, the government often takes drastic measures to control the flow of capital. In 1933, Executive Order 6102 forced American citizens to hand over their gold to the government. Shortly after, the government revalued gold from $20 to $35 an ounce. This was a direct theft of purchasing power from the people to bail out the state. History teaches us that when the system is in trouble, the state will always prioritize its own survival over your savings. This is why holding physical assets outside of the traditional banking system is not just a strategy but a necessity for protection. Silver has its own historical compass that points toward $500. During the Hunt brothers' silver squeeze in 1980, the price of silver rose from $6 to nearly $50 in just 1 year. At that time, the amount of paper currency in the world was a tiny fraction of what exists today. We are now in a situation where the silver-to-gold ratio is historically distorted. In nature, there is roughly 15 to 19 times more silver than gold in the earth crust. For most of human history, the price ratio sat near 15 to 1. Today, that ratio has often fluctuated between 80 to 1 and 100 to 1. A return to the historical mean while gold is at $8,500 would put silver well above the $500 mark. The global shift we are seeing today mirrors the fall of the British pound as the world reserve currency after World War II. When a reserve currency loses its status, the transition is often chaotic and characterized by high inflation and social unrest. The world is currently searching for a new anchor of stability. In every previous transition, that anchor has always been gold. History acts as a compass because human nature does not change. Governments will always overspend, and the people will always eventually return to the only money that cannot be destroyed by a printing press. We are not experiencing something new. We are experiencing the inevitable return to the mean. When we discuss a target of $8,500 for gold, we are not pulling a number out of thin air. This figure is the result of cold, hard mathematical reality when applied to the current state of global liquidity. To understand this, we must look at the relationship between the total supply of US dollars, known as the M2 money supply, and the amount of gold held in reserve by the United States. If the world were to return to a partial gold standard to restore trust in the financial system, the price of gold would have to be set at a level that fully backs the outstanding currency. Based on current debt levels and the total quantity of dollars in existence, $8,500 is actually a conservative estimate for that revaluation. The driver of this target is the unprecedented pace of currency creation. Since the year 2020, the global money supply has expanded by more than 40%. This means that for every $5 in circulation, 2 were created in the last few years. Gold, however, only grows at a rate of about 1 to 2% per year through mining. This massive disconnect creates a pressure cooker for the gold price. In previous cycles, when the ratio of the gold price to the monetary base became this extreme, a violent upward correction followed. We are currently at a historical extreme that mirrors the conditions seen just before the massive gold bull markets of the 1970s and the early 2000s. Furthermore, the demand side of the equation is being driven by a fundamental shift in how nations view their reserves. For decades, U.S. Treasury bonds were considered the safest asset in the world. But in 2022, when the West froze the Russian foreign exchange reserves, the world changed forever. Every central bank on the planet realized that if their money is held in a digital ledger controlled by another nation, it is not truly theirs. It is a permission-based asset. This has triggered a massive rotation out of debt and into gold. As central banks from China to the Middle East continue to sell their bonds and buy physical gold, they are creating a floor for the price that is much higher than anything we have seen in the past. We must also consider the role of institutional investors. For the last decade, most pension funds and insurance companies have held 0% of their portfolio in gold. They have been focused on the stock market and tech growth. However, as inflation becomes structural and the traditional 60-40 portfolio fails to protect wealth, even a small shift of 1 or 2% of institutional capital into the gold market would overwhelm the available supply. The gold market is tiny compared to the bond and stock markets. A small trickle of money from the big institutions would act like a fire hose in a teacup, forcing the price to accelerate toward the $8,500 target with incredible speed. Finally, the $8,500 target represents the point of psychological surrender for the fiat currency system. It is the level where the general public finally realizes that the dollar is not coming back to its former strength. When the crowd rushes for the exit at the same time, the price moves vertically. We are currently in the quiet accumulation phase before that rush begins. The silent builders are positioning themselves now because they understand that once the target becomes visible to everyone, the opportunity to buy at a reasonable price will be gone. While gold is the anchor of the financial system, silver is the engine of the technological world. If gold is the metal of kings, silver is the metal of necessity. The path to $500 silver is not just paved with monetary fear, but with the undeniable laws of supply and demand. Currently, the world is facing a structural silver deficit that has persisted for several years. We are consuming more silver than we are mining, and the gap is being filled by dwindling above-ground stockpiles. This is a math problem that can only be solved by a massive increase in price. The primary driver for silver in the year 2026 is the global transition to green energy and advanced electronics. Every solar panel contains approximately 20 grams of silver. As the world pushes for carbon neutrality, the demand from the photovoltaic industry alone is expected to consume over 20% of the total annual silver supply. When you add the silver required for electric vehicle components, 5G telecommunications, and the massive expansion of artificial intelligence hardware, you see a demand profile that is completely inelastic. These industries cannot function without silver, and there is no cheap substitute. They will pay whatever price is necessary to secure their supply chains. Unlike gold, which is mostly stored in vaults and recycled, a significant portion of silver is consumed in industrial processes and never recovered. It is often used in such small quantities in individual devices that it is not economically viable to recycle. This means that every year, millions of ounces of silver are effectively lost to landfills. While the world treats silver as a cheap commodity, it is actually becoming one of the rarest essential elements on the planet. We are approaching a moment of physical scarcity where the industrial users will have to compete with monetary investors for a shrinking pool of metal. The silver to gold ratio is the ultimate signal for the $500 target. Throughout history, the ratio has averaged 15 to 1. During the peak of the 1980 silver spike, it dropped to 17 to 1. Currently, the ratio is highly distorted, often trading above 80 to 1. If gold reaches our target of $8,500 and the silver to gold ratio merely returns to its historical average of 15 to 1, the price of silver would be over $560. This is not a radical prediction. It is a return to the natural balance that existed for thousands of years before the era of paper manipulation. Finally, we must look at the silver market liquidity. The silver market is significantly smaller and more volatile than the gold market. because the price of silver is currently so low compared to gold, it takes much less capital to move the price. When the public realizes that gold has become too expensive for the average person to buy in significant quantities, they will flood into the silver market as the only affordable alternative. This retail rush, combined with industrial panic buying and short covering by large banks, will create a vertical move. Silver at $500 is the destination for a metal that has been undervalued, underappreciated, and overshorted for nearly half a century. The history of wealth is not written by the loudest voices in the room, but by those who understand the psychology of cycles. To navigate a world where gold reaches $8,500 and silver hits $500, you must distinguish between two types of market participants: the reactive crowd and the silent builders. The crowd is driven by dopamine and headlines. They buy when the price is already at the top because they see others making money. They sell in a panic when the market corrects because they lack a fundamental understanding of why they owned the asset in the first place. This emotional volatility is why the majority of people lose money even in a bull market. In contrast, the silent builder operates on a different frequency. They are the individuals who began accumulating physical assets when the media was calling gold a dead rock and silver a boring industrial metal. They do not seek validation from the evening news or the approval of their neighbors. In fact, they prefer to move in silence. They understand that real wealth is built during periods of maximum pessimism. When the global financial system shows signs of stress, the silent builder does not panic. They simply execute a predetermined plan. They recognize that the separation point between the wealthy and the struggling is the ability to delay gratification and maintain discipline when the world feels chaotic. The crowd is currently distracted by 1,000 different noise signals. They are chasing the latest digital meme coins, over-leveraging into overvalued tech stocks, and spending their declining purchasing power on status symbols that depreciate the moment they are purchased. They are playing a game designed by the institutions to strip them of their capital. The silent builder, however, focuses on the signal. They look at the debt to gross domestic product ratios, the central bank gold reserves, and the declining yield on traditional savings. They treat their income like a tool for construction. Every ounce of gold and every bar of silver is a brick in a fortress that protects their family from the coming currency debasement. The most powerful advantage of the silent builder is their time horizon. While the reactive earner is worried about the price movement over the next weekend, the strategic builder is thinking in decades. This shift in perspective removes the emotional sting of market volatility. If silver drops 5% in a day, the crowd screams that the dream is over. The silent builder sees it as a clearance sale, an opportunity to acquire more of a finite asset with depreciating paper currency. They understand that they are not trading. They are exchanging a failing currency for a permanent one. They are moving their value from a leaking bucket into a solid vault. Success in the coming reset requires a complete identity shift. You must stop identifying as a consumer and start identifying as an architect. A consumer reacts to what is available. An architect designs what will be. As gold and silver begin their ascent toward these historic targets, the pressure to follow the crowd will become intense. The media will flip from skepticism to extreme hype, and the fear of missing out will drive the masses into a frenzy. The silent builder will already be positioned, watching the spectacle with a sense of calm. They have already done the work. They have already built the foundation. When the world finally wakes up, the silent builder is already home. The move toward $8,500 gold is not occurring in a vacuum. It is being accelerated by the most significant geopolitical realignment since the end of World War II. For over 80 years, the United States dollar has enjoyed the status of the world reserve currency, backed by the petrodollar system and the absolute dominance of the American financial network. However, in the year 2026, we are witnessing the emergence of a multipolar world where the dollar is no longer the only game in town. The phenomenon known as de-dollarization is moving from a theoretical risk to a daily reality. The primary catalyst for this shift is the expansion of the BRICS nations, Brazil, Russia, India, China, and South Africa, along with their new members. These nations represent over 40% of the global population and a massive share of the world commodity production. They have realized that relying on a currency controlled by a single Western power is a strategic vulnerability. As a result, they are aggressively developing alternative payment systems and settlement mechanisms that bypass the dollar entirely. When these nations trade oil, gas, and minerals in their local currencies or in a new gold-backed accounting unit, the global demand for dollars drops significantly. This brings us to a critical economic law. When the demand for a currency falls, while the supply continues to explode through deficit spending, the value of that currency must collapse. As dollars are sent back to the United States from foreign central banks that no longer need them for trade, we will see a massive influx of liquidity that will drive domestic inflation to levels never seen before in modern America. In this scenario, Gold serves as the ultimate neutral asset. It is a currency that has no nationality and cannot be sanctioned or frozen by any government. This is why the global East is accumulating gold with such ferocity. They are preparing for a world after the dollar. We are also seeing the weaponization of finance. The decision to use the global payment system as a tool of warfare has forced even neutral nations to reconsider their reliance on Western institutions. If your national reserves can be erased with a single keystroke in Washington or Brussels, then your sovereignty is an illusion. This realization has triggered a sovereign gold rush. Nations are not just buying gold, they are repatriating it, bringing their physical bars back from foreign vaults in London and New York to their own soil. They want the metal where they can see it, touch it, and control it. For the individual investor, this geopolitical shift is the ultimate confirmation of the $8,500 gold thesis. We are moving toward a new Bretton Woods moment, a fundamental reset of the international monetary order. In every such reset in history, gold has been the bridge between the old system and the new one. As the world loses faith in paper promises issued by overextended governments, it will return to the only asset that has provided stability for 5 millennia. The geopolitical tectonic plates are shifting, and gold is the only bedrock that will remain standing when the dust settles. In a world of $35 trillion in debt and shifting global alliances, you do not need more speculation, you need immunization. To immunize your wealth is to make it resistant to the viruses of inflation, bank failures, and currency debasement. Most people approach investing as a way to get rich quickly, but the strategic builder approaches the next decade as a mission to stay rich and stay free. The strategy for navigating toward $8,500 gold and $500 silver requires a move away from paper abstractions and toward physical sovereignty. The first step in the strategy of immunization is the elimination of counterparty risk. A counterparty risk is the danger that the person or institution on the other side of your contract will not be able to fulfill their obligation. When you own a bank deposit, you have a counterparty risk with the bank. When you own a government bond, you have a counterparty risk with the state. When you own physical gold and silver held in your own possession or in private, non-bank insured vaults, your counterparty risk is zero. The metal does not rely on a CEO, a politician, or a computer network to have value. It simply is. In the coming reset, the difference between having a digital claim on gold and having the physical metal will be the difference between a promise and a reality. The second pillar of this strategy is the concept of tiered liquidity. You must have a structure that allows you to survive a short-term crisis while positioning for long-term growth. This means holding silver for small, daily transactions and gold for the preservation of significant capital. If the banking system experiences a temporary freeze, which history suggests is a common occurrence during a monetary reset, silver coins provide the ultimate medium of exchange. They are divisible, recognizable, and carry intrinsic value. Gold, on the other hand, is your portable insurance policy. It allows you to move massive amounts of value across borders or through generations in a compact, indestructible form. Third, you must understand the rebalancing act. As gold approaches the $8,500 target, its value relative to other assets like real estate and stocks will change dramatically. During the 1930s and the late 1970s, there were moments when a small amount of gold could purchase an entire city block or a significant share of the stock market index. The goal is not just to collect metal, but to use the metal as a vehicle to acquire productive assets when they are at their historical lows. By being immunized with gold and silver now, you are positioning yourself to be the liquid buyer when everyone else is a forced seller. Finally, immunization requires a mental shift regarding price. You must stop measuring your wealth in dollars and start measuring it in ounces and grams. If the dollar loses 50% of its value and the price of gold doubles, you haven't actually made a profit. You have simply maintained your position while others were wiped out. The true victory is not the number of zeros in your bank account, but the amount of real-world purchasing power you control. By following a strategy of consistent, quiet accumulation, often called dollar cost averaging into physical metals, you remove the emotion from the process. You are not gambling on a price spike. You are building an immune system for your future. True wealth is not measured by what you can spend today, but by what survives into tomorrow. The journey toward $8,500 gold and $500 silver is not merely a trade. It is the construction of a legacy. Most people think in terms of a single lifetime, or worse, a single fiscal quarter. But the strategic builder, the architect of their family destiny, thinks in terms of generations. They understand that a legacy is built on a foundation of assets that do not rot, do not rust, and cannot be erased by a government decree. In every major economic collapse throughout history, the families that emerged stronger were those who held their wealth in physical form. I once studied a merchant family in Europe that had preserved its influence through 2 world wars and multiple currency devaluations. Their secret was simple. They maintained a constant 10% of their net worth in gold, passed down from one generation to the next. This gold was never touched for consumption. It was the ultimate emergency fund, a silent guardian that ensured that even if their businesses were seized or their currency became worthless, the family would never start from zero. This is the power of the legacy blueprint. Creating a legacy requires a shift from a consumer mindset to a steward mindset. A consumer asks how much they can take from the world. A steward asks how much they can protect and pass on. When you acquire silver at its current levels, you are not just buying a metal, you are buying time and opportunity for your children and grandchildren. Because when silver reaches $500, it will no longer be accessible to the average person. It will be a restricted, strategic asset. By positioning yourself now, you are securing a seat at the table for your descendants before the price of admission becomes prohibitive. A critical part of this blueprint is education. Giving your heirs gold without giving them the wisdom to manage it is a recipe for disaster. You must teach them the language of cycles, the history of money, and the discipline of patience. They must understand that the gold in the vault is not money to be spent on luxuries, but a sacred trust to be guarded. It is the insurance policy for their freedom. By involving your family in the process of building this foundation, you are transferring more than just wealth. You are transferring a philosophy of resilience. The legacy blueprint also involves diversification of jurisdiction. As we approach the final stages of the fiat experiment, the pressure on governments to implement capital controls and wealth taxes will increase. The prepared individual ensures that their legacy is not tied to the whim of a single jurisdiction. Whether through private storage in stable, neutral countries or through the physical possession of high-value coins, the goal is to remain agile. A legacy that can be frozen is not a legacy at all. It is a temporary loan from the state. By building your fortress with gold and silver, you are ensuring that your life work remains your own. We are standing at a unique crossroads in human history. The signals are no longer whispers. They are clear indicators that the global financial architecture is being rebuilt in real time. The projection of $8,500 gold and $500 silver is not a reason for fear, but a call to design. You have two choices. You can remain a passenger in a system that is losing its way, or you can become the architect of your own financial destiny. The future does not belong to the lucky or the loud. It belongs to the prepared. The first action you must take today is a cold assessment of your current foundation. Look at your assets and ask yourself how many of them are paper promises and how many are physical certainties. If 90% of your wealth is tied to digital ledgers, bank promises, and currency that is being printed at a rate of billions of dollars per day, your architecture is fragile. Your task is to begin the process of migration. You do not need to move everything at once, but you must start. Every ounce of silver and every gram of gold you acquire is a step toward immunity. You are building a bridge from a system of debt to a system of value. Second, you must commit to a process of constant learning. The world of 2026 is moving faster than any period in history. Understanding the nuances of geopolitical shifts, central bank policies, and the silver supply deficit is your greatest competitive advantage. Knowledge is the only asset that the state cannot tax and the markets cannot devalue. By staying informed and disciplined, you avoid the emotional traps that destroy the crowd. You stop being a victim of the headlines and start being a student of the cycles. Third, share this mission with your circle. Wealth and security are more powerful when they are shared by a community of like-minded individuals. The silent builders are stronger when they recognize each other. Talk to your family, your partners, and your friends about the importance of tangible assets and long-term protection. By helping those around you become more resilient, you are building a more stable environment for your own legacy to thrive. The greatest fortunes in history were never built in isolation. They were built by leaders who understood the value of structure and the power of positioning. Finally, remember that the window of opportunity for these price levels will not stay open forever. History shows that when a monetary reset reaches its boiling point, the move is violent and sudden. One day, the price of gold is a headline. The next day, it is unavailable. The time to build your fortress is while the sun is still shining and the materials are still affordable. Do not wait for the applause of the crowd or the confirmation of the masses. Act with intention, move with discipline, and trust in the mathematics of history. Your financial life is the reflection of the decisions you make in moments like this. Years from now, you will look back at this period of global instability as either the moment you lost your footing or the moment you built your empire. The architecture of your future is in your hands. Start building it today, and you will walk through the coming storm with the quiet confidence of a man who knows exactly where he stands.